Guys, the Fed is lying to us. And if you base your investments on the lies that the Fed tells you, you will end up broke and they will stay rich, same as it ever was. So let's look at these lies and see the effect it is having on the stock market and what you can do to limit the damage to your wealth. As you know, the Fed raised the Fed funds rate by 3/4 of a point, and now they are saying all kinds of things about them being worried about inflation. Let's take a look. So the Fed and the White House can't even keep their lies straight. Powell is saying inflation is running too high, and Biden is saying it is hardly at all. So this rate hike brought the benchmark lending rate to between 3 and 3.25%. And the Fed is saying that the committee is highly attentive to inflation risks. I'll show you what they said a year ago in a minute. And Powell said soaring prices and that cooling red-hot inflation would not be painless and could require relatively modest increase in unemployment. I wish there was a painless way to do that. There isn't, he said. However, Joe Biden has said that in the past few months, inflation hasn't spiked and that the inflation rate month to month was just an inch, hardly at all. Now, for their lies to work, they have to count on people having a short memory. So let me just remind you what Powell said just July 14th, 2021, just a little over a year ago.
We do see that inflation expectations are moving up, or inflation is on a path to remain well above our goals and risk of setting us off on a period of high inflation. Then we'll use our tools to guide inflation back down to 2%. So in the end, it's not going to be. In the end, it will be transitory, and people need to have faith in the central bank that we will do that. But we won't do it just because. Honestly, it would be a mistake to do it at a time when we really do believe, and virtually all forecasters do believe, that these things will come down of their own accord.
Did you see that part where he tried to shift the potential blame to other forecasters, where he said virtually all other forecasters say it's going to be transitory? They say that because he said that, and they're just parroting him. But now he can use that later on to go back and say, gee, who knew that it was not transitory? All these forecasters, not just me, said that it's transitory. So we're all just dumb, right? So these are the smartest guys at the Fed, but just a year ago, they had no idea that spending all that money would cause inflation. Either they are a lot dumber than they portray themselves, or they are flat out lying. And so in just a little over a year, we went from inflation is transitory to inflation is now so serious that Powell says they need real rates to be positive across the whole yield curve. Let's take a look.
We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time you'd see positive real rates across the yield curve, and that is also an important consideration.
So what this means is that he is saying that interest rates minus the CPI or inflation rate needs to be a positive number. Well, what does that look like? Well, if the CPI is 8.6%, then interest rates, whether they are 90-day treasury bills or a 30-year bond, need to be above 8.6%. You get that? So either the CPI will have to come way down below where rates are now, around 3.5–4%, or rates are going to have to go a lot higher. This is what is needed to try to stop inflation. And just so you know, anytime the CPI has gotten above 5%, the Fed funds rate needed to be higher than the CPI rate to bring down inflation, which means the Fed funds rate is going to have to be higher than 8.6%, or the CPI is going to have to miraculously come down a whole lot. And you can see that here in this chart, inflation gets above 5%. They have to bring the interest rate here in the yellow above that level to crush it. Same famously Paul Volcker in 1980, 1981, and that has continued through to now. You can kind of think of inflation like a fire that starts in a skyscraper. If the fire department comes and the fire is already up to the third floor, but they're only pouring water on the first or second floor, that's not going to stop it from going up higher. So as it gets to the fifth floor and they're still watering the third floor, like 3% interest rates, while inflation is now at the eighth floor, they have to pour the water up at a much higher floor, like the ninth or 10th floor, to make sure that that fire does not spread up higher. That's kind of the same thing with the inflation thing and why they need to go to a lot higher interest rates to stop inflation. Now, they know what needs to be done, but they're dragging their feet in part because of the November election and their hopes that the pandemic bubble will revert back down a bit, and maybe that energy will come down more with a recession and lower the CPI even a little bit so that they can stall and say that the worst inflation is behind us and we will monitor the situation going forward type BS. In the meantime, the stock market is starting to realize that the soft landing scenario is another lie that they will use until they can no longer lie right to your face. Stocks are starting to react to this realization and are close to retesting the June lows. So let's take a look where we are right now. So here's a chart of the DIA, which is the ETF of the Dow Jones Industrial Average. This is a monthly chart. This is a weekly chart. This is a daily chart. Right now, the Dow is down about 2.5% or about 700 points. And it is now lower than that June low. Here's the S&P 500, and it is almost at the June low retest right now. And this is a 50-month exponential moving average that has been support on the first move down in June. But now it is looking like it is going to break through there. Same goes for the QQQs, the NASDAQ 100. It is almost at the level of the June lows. And so the psychology behind this is that the people who bought over here, when this thing came down all the way down here, a certain amount of people sold, but a certain amount of people did not sell, thinking that they're just going to ride it out and you should buy the dip. And some people did buy the dip. Some people got long here for a bounce, and it did bounce. But now that it's coming back down, the people that bought down here for a bounce are realizing this is not working out. And maybe the people that have been holding from up here that thought the worst was over are now realizing that there's more bad news to come. And so when this breaks through this June low, we may get a flush of both of those people, and including new people shorting the market, also selling into this move down. And here's a monthly chart of the VIX, the volatility index. And this is why I say that we are not at the lows yet, because people are still complacent. They're still bullish. They're still believing in buy the dip. They're still believing in meme stock shorts and buying Tesla and Apple at any price. And so we are only just now above about 30 on the VIX. However, look at these spikes here. The VIX has spiked to 85 in 2020 during the pandemic and almost 90 during the 2008 financial crisis. And it had spikes up to above 40 in other times between that. So until you see people really capitulating and the VIX spiking up to, say, above 40, I would not be looking to buy any dips or start getting long into stocks at this time. And if you want to see another indicator of the general consensus out there, is it bullish or bearish? Here is a look at Fidelity, and they show the number of buy orders versus sell orders, or the buy-sell ratio on all the top stocks of their customers. Tesla buy ratio 67%, Triple Q 70%, meaning triple long the QQQ versus the short QQQ, only 43% buy ratio. SPY 68% buy, Amazon 77% buy. VOO, the Vanguard S&P 500, 95% buy ratio, 3375 buy orders versus 177 sell orders. This does not look like anywhere near capitulation to me. And here's an indication of the set it and forget it people. VTI, 93.8% buy ratio. This is the total stock market index for Vanguard. And so this is probably mostly Graham Stephan just dollar cost averaging into the VTI because that's what he talks about all the time. So this is an indication of the people that just say, close your eyes and just keep buying the dip and eventually it will work out. When you see this thing flip the opposite where 50% or more of the people are sellers, then maybe we'll be close to a bottom, I believe. So what can you do to protect your money? Well, I'm staying out of stocks until I see a big spike in the VIX and some real capitulation. Until then, even very short-term government bonds and corporate bonds are not doing very well. So to me, the best bet is to stay liquid in cash or money market accounts or very short-term treasuries until it looks like the rate hikes are over. But that could be a very long wait. So if you would like to see a video comparing some different bond investments, let me know in the comments below. As always, this is not investment advice and this is your money, so you need to make your own decisions and don't listen to the guys on YouTube or CNBC or whatever. Thanks for watching, guys. I'll see you in the next one.